Hello students. Today we are going to discuss about the introduction of insurance. So basically in this topic we need to understand what is insurance, what are the basic purpose of insurance and how the insurance works. So basically the insurance is a form of risk management tool, and in this we hedge against the risk regarding the contingency or the uncertain losses. Insurance is defined as the transfer of risk of a loss from one party to another in exchange of a payment. When we talk about the insurance, in insurance, the one is insurer, that is basically a company who is selling an insurance. The other one is the insured or the policyholder, who is the person who is buying insurance. The amount to be charged on certain insurance for the insurance coverage is called premium. Risk management, the practice of appraising and controlling risk that has been involved as a discrete field of study and practice. If we are talking about the history of insurance, so the insurance sector dates back to the 1818 when the Oriental Life Insurance Company was formed in Kolkata. A new era began in India with the Life Insurance Act of 1912. The Indian Insurance Companies Act was passed in 1928. This act empowered by the Government of India to gather the information about life insurance and non-life insurance organizations. The Trenton Insurance Company Limited, formed in 1850 and was the first of its kind of general insurance sector in India. Established in 1907, Indian Mercantile Insurance Limited was the first company to handle all forms of Indian insurance. Now when we talk about the reforms of an Indian insurance, so the formation of Malhotra Committee in 1993 initiated the reforms in an Indian insurance sector. The aim of this committee was to form the basic functionality of Indian insurance sector. The committee has several recommendations which offers the operational of insurance services and the regulatory body formation. So after that recommendations, the IRDA, that is the Insurance Regulatory and Development Authority Act of 1999, brought against the several crucial policy changes in the insurance sector. It led to the formation of Insurance Regulatory and Development Authority in 2000. Now we'll talk about the basic terminologies of insurance. So basically, first is the insurance contract, that is the contract which has been formed between the insured and insured. Then the second is the capacity of parties, that means in an insurance contract, the parties who are capable to make a contract can only be the parties of insurance. There should be a legal plan, that means the particular object of that insurance should be legal only. And the second is the indemnity. Indemnity means the compensation for loss. So one party who is in a loss, then the aggrieved party or the other party has to pay for that loss. And the last one is the conditional. Conditional, that means that the one condition is that the company insurer is paying something in case of any contingency, any loss happens or occurs. So this is a conditional. Now another important terminology is the insurable interest. Insurable interest, here it means the person or the property in which there is a relationship, that there is some relationship, that means the insurable interest is there. For example, if a wife has an insurable interest in her husband's life because she would be financially harmed if he were to die, so there should be an insurable interest in there. Then there should be a mutual assent. If one party is offering something, so other party has to accept that by mutual consent. And the most important part is that consideration. So consideration here something that in return of that contract, so the consideration should always be there. Now very few basic terminology, that means that the insurer, the person who is agreeing to pay for the losses. Insured, the person who were insured in his risk with the insurer. Premium, that means the amount consideration decided by the insurer and insured for indemnifying the losses. Policy is a contract between insurer and insured, and the exposure to risk, that means the possibility of an insured for the occurrence or incurrence of loss, that is called insured's exposure to loss. So here now we need to understand how insurance works. So this is an example. Suppose there is a particular colony, there were 600 houses, each having a worth of rupees 30,000. Every year there is a probability of 3 houses getting burned. So now the resulted loss per house is 30,000 and the total loss being 90,000 rupees. So if all 600 homes owners pool rupees 150 each to the pool of unfortunate people whose house was burnt, can be easily paid. So this is the way how insurance works. That is called the principle of sharing. So thank you, students.